What I thought about investments in October 2002. Just going through my book, John Bogle's Common Sense on Mutual Fund, which I got when I was at Vanguard, and I got it signed by Mr. Bogle. So I'm going to do a video here in just a second on how to predict future performance on stocks. Anyway, I'm just going to read this to you. I find it incredibly interesting. I remember October 2002. I was in. We're living in Dayton, Virginia. Let's actually hold on a second. This curve is just me, Shar, and Maddie. We'd even have Chloe at that point. So I was 32 years old. Yeah, 32 years old. The market had now tanked because remember, it went into March of 2003 when the market kept going down. I think I was a branch manager at First Citizens Bank in Harrisonburg at that point, I believe, or maybe I can't remember, but I believe I was in banking. I can't remember if I was still at First Union or First Citizens. I just don't recall. But anyway, it's interesting how 20 years later how things change. And so what are we in? February 2022. This is literally 20 years ago. Let me show you. I find an old picture of my house, but it's kind of like that. It's pretty. That was I think that's our next door neighbor actually. We were at 250. That's 235. So that's across the street. Yeah, that was across the street. But it's a small ranch house. When we bought it, it cost 108, something like that, I think, and we bought it in 2001, 2002. I can't remember. But then we sold it. Let me just go to maps here. We sold it in 2008 for $239,000 after we put a pretty significant master bedroom on there. We only had 3 beds and 1 bath. But then as the family grew, we grew with it. So let's just see. We're going to go to, okay, I guess I can only go here. So we're just going to show you kind of the neighborhood that we were, just houses like that. Single family, or single floor ranches. That's it. And we were right, let me just go up here real quick. I can probably, we actually almost bought that house right there. I remember that. Anyway, so we were just right on the other side of this guy's house right here. If I can get back there. Let me see. And that was the UMC that I've gone to a couple times. Anyway, point being, it's, that's a whole lot different from where we are now, 20 years later. And yet, it's interesting. So let's just have this. All right, so in October 2002, excuse me. So I say interest rates are 40-year low, and this is just reading after, just kind of thinking about where we were in 2002. Stocks down 20 to 50% from highs of 3 years previously. Hold on a second. So stocks are down 20 to 50% for the last 3 years, yet bonds average 10 to 12%. Dividend yields gone up from 1.5% to 2%, but we're still very low. Economy, not much growth expectations. Remember, this is after September 11, 2001 and everything in the tech bubble disruption. Earnings were forecasted between 3 and 5% for the next year. Potential war in Iraq, North Korea. Dems winning Congress in 2002. So remember, this is October 2002. We're going to a mid-year election when the outer party usually wins and maybe takes back Congress. No threat of inflation unless war heats up. And it actually didn't do much. Where is growth going to come from, I said? If dividend equals 2 and earnings growth is 4, inflation is 1.5, 4.5% real return is what my expectations were. But not considering speculation, just on fundamentals. Dividends yield plus earnings growth. And then you factor out inflation. So real returns of 4.5. 5-year CD back then was 4.5. No risk, no speculation necessary. So for stocks or CD, if you thought you were going to get 4.5% rate of return on stocks, you can buy the CD and get the same thing. And here's the fundamental thing, man. If interest rates begin to creep up, as we saw in the last 2 weeks of October 2002, bonds drop, people move into equities. But that doesn't solve fundamentals of low dividend plus low earnings growth potential. So basically my argument was, if interest rates go up, people sell their bonds. That's what I thought. And that's what a lot of you guys think. It's just there's no evidence of that happening. But that's what I thought too. And I said, well, they're going to sell their bonds and move into stocks, right? Well, turned out that wasn't necessarily true. Unless Congress changes taxation on dividends, make it more equitable to capital gains. because they're basically, dividends are double taxed. All right, so you get taxed as a dividend receiver. You receive the dividend, you got to pay income tax on it, and the company that made the profit to pay you the dividend has to pay income tax on the money which they paid you with, if that makes sense. Capital gains, long-term capital gains were taxed differently than qualified dividends back then. And so Bush, and rightly so, he made dividends taxed more favorably than ordinary income, because before it used to be taxed as ordinary income, which is significant. So they did change that. Didn't do much for dividends dividend rates though. It just didn't. Not yields now. Yields are contingent on the price of stocks. In terms of dividends, the actual dollar amounts didn't change much. It's pretty interesting actually. And on top of that, when Congress changed the dividend, the qualified dividends from ordinary income to qualified dividends, you know what they did not change? The deductibility of debt. And that's the issue why a lot of companies take on debt as opposed to paying a dividend, because they have to pay tax on the profits they make on the cash in which to pay the dividend. They get to deduct the debt. It's been going on like this for a long, long time. Remember, and consumers used to be able to deduct credit card debt, believe it or not. Let's see. Not much incentives for companies to increase dividends due to double, triple taxation. Only way yields increase is if share prices go down, if they don't increase the actual dividend they're paying. Let's see. Or companies increase their payouts, and you don't want the companies to increase their payouts. The payout ratio is just a percentage of the profits they pay out in dividends. You start getting up to the 70 and 80% payout ratios, that gets a little bit nervous, because how are they going to continue if they have a couple bad years of earnings? Only by taking on debt, and that's not a good thing. All right. So yields stay at about 2%. Economic conditions show an earnings growth of 3 to 5, well below historical norms. Speculation probably negative on stock returns. And that was proven right there. So even if interest rates creep up, without fundamental change in economic conditions, little chance for drastic earning increases. Would need a minimum of 6% earnings growth to at least equal historic norms. Companies won't magically put money into increasing dividends, not while debt is high, layoffs abound, stock buybacks seem to be preference. Yeah, even back then we're saying stock buybacks seem to be preferred. Interesting. Lots others to do with, I can't read what I'm saying. Maybe at most 5 to 10% dividend increases on a few stocks, but taxation is still a problem. So my thesis: need drastic change in taxation of dividends to see much increase in stock markets. As interest rates increase and people move from bonds to stocks, ? Maybe even CDs, that will increase speculation on, I can't see what that says, but that's temporary. I can't see what that says. That will increase speculation on something, but that's returns, I guess. But that's temporary. So I need to find out how buybacks have affected stock appreciation. Research companies like Dominion Resources will issue $100 billion in new equities to keep paying dividends. Research Dominion Resources, which will issue $100 billion in new equities to keep paying dividends, drive down share price. Bondholders not happy. Stockholders killed. Need reason for companies to increase dividends. Earnings growth is anemic. Dividends keep management honest. Age of corporate distrust. Stocks slump. Increasing dividends will help responsible companies and increase stock markets. That was my thesis right then, is that if you're worried about the markets, the way to get companies to get over the Arthur Andersen and the Enron debacle, and I can't remember if that was Enron at that point, is to increase dividends, because that keeps companies honest. Anyway, it was interesting. A great book, man. Great book. So that was in October 2002. Let's see what the markets did since. Hold on a second. Next 5 years, from 2003, 4, 5, 6, and 7, $10,000 invested in the S&P 500 gave us $18,000. So we made 80% over 5 years, which is a total rate of return of 8.61. All right, that's not so bad. I was a little bit off there. I figured about 6.5% net or gross of inflation. We got 8.61% gross of inflation. And so I would have to think some of that has got to be attributed to PE ratios, or maybe a little bit better earnings in terms of net profits than I was thinking. But still, I said 3 to 5%. I said 4% year-over-year growth, plus 2% dividends, minus 1.5 inflation. So we got 6.5, 2% to 6. So I was off by what was it, 8.6%, and I said 4%, 2%. I said 6. Yeah. So I was wrong there for sure. And then you had, but if it would have had 5% growth, I still would have been off. So it did better than my anticipation was at that point. Let's go to 20. Let's actually hold on a second. What do I want to do here? I want to go to 20. Let's just go to 2021. And this is where you can't just say, well, I said in 2002. I mean, you can. You can do whatever you want. But you shouldn't, because it's stupid. Things change. All right. So here we have 10,000 grew to 77,000 by 2021, full 11.37% rate of return. And that's where I'm going to come up with my video here in just a second. Now, that's interesting. Now, look at that. Huh. It's just because that right there. All right, so let's go to 2000 to, let's say, the 10-year track record to 2000. What's that? Could be 11, not 12. Yeah, 2012. Let's see where we were there. And that's going to include 2008, so it could be cherry picking. Yeah, I don't care. Let's see. 6.99. Right on, man. So I was spot on. Isn't that interesting? 6.99. There you go. Because I said, basically 2% dividends yield plus 4% earnings growth. That's 6%. I gave a 5% on the high end, a little bit of price appreciation as well. If you have PE ratios increasing, which I imagine they probably did, but that's fun, man. I like doing that stuff. All right, we'll see you guys. Love to hear your thoughts. What were you predicting in October 2002? Do you remember? Has things changed? Low interest rates creeping up. Dividends are still low. Where's the earnings going to come from? It's the same thing. What were the big companies in 2002? I don't think it's Apple, because I think Apple. Actually, let's just take a look at Apple. I know them. I wish you'd just keep it. Yeah, let's go to AAPL. And let's just go to 2007. All right, there we go. All right. So Apple, 2003 to 2007. Wow. It took off like look at that. 36%. Look at that. Nuts, man. But let's go to 1997. Because this is when Apple, the first year, this is when Apple went to Bill Gates and said, please help us, Bill. Please help us. And Apple was at like 7 back then. Look at that. 10,000 invested with $6,000 a year later. That's nuts, man. And then it went to that in 2000. Then it went, you just don't know. You just don't flip and know. Let's go to GE. No one was thinking, wow, is GE not even GE? Whoa. Hey, what's up, man? Why is it where's GE? It's AT&T. Huh. It's not how those stocks. No. All right. That's interesting. Yeah. Love to hear your thoughts. We'll see you.